that mean? And how much have we investors sort of been lazily just climbing on the back of those central bank whales and just riding through a sea of stock market gains?
A sea of bliss, indeed. No, but that's exactly it. And I think what Powell has been pushing very hard to wean the markets off the Fed puts. And if you look at his behavior, his language at the last press conference, to the dismay of many market participants, he simply refused to give any clues. And I think what is happening is Powell wants to leave his door wide open. And the reason for that is it's a shift away from Wall Street to Main Street. Finally, it's a shift to what's happening in the real economy. And the reason for that is very, very clear. It's inflation. It's the impact on, the average Joe. It's the fact that more than a third of Americans have less than $1,000 of savings to their name. The labor market is finally strong enough to start normalizing, or at least start the path of normalizing of monetary policy. And what does that mean for investors? To your point, there has been a lot of complacency in the markets, simply piggybacking central banks versus a much more strenuous, proactive security analysis was a very profitable approach. And it does feel very strongly that that tide is turning.
Are they going to be able to do that, though? I mean, those are noble goals. Help the working people because the wealthy people have made enough money. But is raising rates 4 or 5 times, maybe, which I do not think they will, but many on Wall Street do, and they're smarter than I am, will that work?
I mean, it feels that nobody actually knows what's going to work. And that's also perhaps why, the Powells of this world are being very careful about his discourse. He simply doesn't want to commit to whether it will be 3, 4, 5, even 7 rates. He doesn't want to commit to whether the increments would be 25 basis points or 50 or something else, because it's simply wait and see. So will it work? We don't know, but certainly something has to be done. And I think, quite frankly, this addiction, this concept of free money, this sort of indiscriminate, valuation of companies. If a company appears to be a tech stock, it would have an indiscriminate X times sales multiple. It does feel that those days are over.
Well, it certainly did in January, which seems like, I don't know, so last month ago, because January, that's what happened. Stocks got crushed, high valuation, money-losing companies got just beaten over the head, and everybody said, well, when rates go up, you can't spend as much or pay as much for these types of valuations. Now we've had a little mini run the last few days. How do you think it all ends up, Anneka, shaking out?
Well, that's interesting. So to your points, and especially looking at the mini run afterwards, it has become much more stock specific. It has become much more idiosyncratic. So when a large, loved tech name misses on earnings, it's brutal. They get completely tarnished. But when a large tech name does well on earnings, it's the other way around. So I think what's happening is there's 2 factors. On one hand, it's the usual discourse. If rates go up, that's not good for the future value in terms of the NPV and the discounted cash flow. That will have a negative hit on the valuations of companies, especially growth stocks, etc. On the other hand, there is an amazing amount of growth, independent growth momentum visible in the economy, and specifically for certain companies that have excellent industrial positions or excellent positionings with excellent moats, with excellent pricing power, where the real cohort behavior of their clients, of their revenue base is very, very strong. They still have a fantastic time ahead of them, right? Because
that sounds excellent, by the way. That sounds excellent. But who are those types of companies? Like, what's an example of a company like that?
Yeah, that's the fun thing. So, often in these situations, it's a question of, well, there's a rotation. It's a rotation from growth to value. It's a rotation from this area to that area. It's a rotation from one geography to another, from US to Europe because of the catch-up trade. I simply think that just does not work anymore. So, even if you take what's happened in the tech world and saying, well, tech will be sold off because rates going up, that doesn't work either, right? So if you look at the divergence between the Netflix and the Apples of this world. So I think what is happening is it's not about a certain sector. It's not about tech. It's not about others. I think it's just an overarching concept of is a business good enough to stand on 2 feet, regardless of whether we are exiting a valuation re-rating world and perhaps entering a valuation de-rating world? I think that's one side of it. And the other side of it is, from a geographical perspective, there is a point to be made that Europe is starting to stand out like a sore thumb. You already saw changes take place last year, but that is certainly an area we expect to see more focus.